Hi, good morning, sir.
Very good morning.
Good morning, everyone. So we can wait for another 5 minutes. Then
Yes. Let us wait for 5 minutes. Usually people join by 11, 5 or 7.
yes.
Good morning, everybody. I think we should start now.
Yes, sir, we can start. Hello, sir.
Yes, starting.
Okay. Welcome, Advocate Vinay Sharaf, sir, and welcome everyone. Welcome to the fourth session of National Tax Lecture webinar series. Over to you, sir. We can start.
Yeah, good morning, everybody. So today we'll be discussing one of the very foundation of the GST law. One of the basic and most fundamental objective of the GST law is to have a consumption-based tax. So the place of supply ensures that the tax is levied at a place where the goods are actually consumed. So the objective or the purpose of the provision of the place of supply is to ensure that the tax goes to the destination state. And in case the destination state happens to be outside the country, then the tax is not levied at all. Because the purpose is that the underlying principle is that the goods or the services are exported, but the tax is not exported. So we need to determine the place of supply, not only to determine which state will earn the revenue, but it is also essential to determine the aspect of whether the export of goods or services has taken place or not. One of the fundamental folly or the error which I have experienced with respect to determination of the transaction of export is that many a time people have the misconception that just because you have received the payment in the foreign currency, so automatically it means there is an export. That is not the case. You need to determine whether the place of supply is outside India. Only if we satisfy the definition of the condition of the place of supply being outside India, only in that case, the benefit of export is available. So the place of supply is extremely important from that point of view. Place of supply is also important to determine whether the import of goods or services has taken place or not. So let us now have a look at the very fundamental aspects of the place of supply, because it determines whether what kind of tax will be levied. We know that in the GST, if the transaction is intra-state transaction, that is within the state, the transaction has taken place, then the CGST and SGST becomes applicable. And if it is an inter-state transaction, then it is a case of levy of IGST. Now here also, one of the fundamental mistake which people make is that just because the buyer and seller are in two different states, they presume that it is a IGST transaction. But again here, in order for a transaction to be covered within the definition of interstate supply, it is essential that the location of the supplier and the place of supply are in two different states. It is not enough that the place of supply, it is not enough if the supplier and the buyer are in two different states. what is important is to determine whether the location of the supplier and the place of supply are in two different states. So here I pose a question to my viewers or the participants is whether it is possible to undertake an interstate transaction if both the supplier and the buyer in the same state. What is your view? So now to answer that, let us first have a reference to or understand there are two things here that it becomes essential to know. One is the location or the location of the supplier. What is the meaning of the location of the supplier or the recipient of the supplier? So while the location of the supplier and the recipient of the supply has been specifically defined in section 2 subsection 20 and section 2 subsection 71 of the CGST Act and section 214 and section 215 of the IGST Act. However, the location of the supplier of goods and the recipient of goods is not defined. So with respect to the location of the supplier or the recipient, the definition says that if the supply is made from a place where the supplier is registered or the buyer is registered, then it is the such location which has the registration which will be considered to be the location of the supplier of the services and the location of the recipient of services. But if the such place is not registered and the supply is made from a permanent establishment of the supplier, then it is that fixed establishment or the permanent establishment which will be considered to be the location of the supplier of the services. Now, I again point out that it is the location of the supplier of the services and the recipient of services which is defined in the law, but the location of the supplier of the goods is not defined. But I believe the manner in which the location of the supplier of the services is defined, there is no harm if we adopt the same meaning for the supplier of services or goods also. Because obviously where the goods are located and a place from where the goods are supplied, it should be considered to be the place from where the supply is made. That should be the normal rule, but there are exceptions to it, which we will discuss subsequently. But for the purpose of the default rule or the general understanding, one may come to a conclusion that the place from where the supply of services or goods is made, whether it is registered or unregistered, ultimately it is the location from which the supply of the goods or service is taking place. That is the place which should be considered to be the location of the supplier. Very good morning to Vijay Kumar ji, who is a Assistant Commissioner of GST from Tamil Nadu. Welcome, sir. If you have any insight or any view, and if you differ with me, then I'd be very happy if you give your opinion of whatever discussion is taking place. So as I was discussing that it is the place from which the supply is made, that is the determining factor to determine the location of the goods or the location of the supply. Now, with respect to the place of supply of the goods, there are 5, you see, determinants or the 5 rules which have been prescribed for domestic transactions. Section 10 defines the place of supply. 10(1) defines the place of supply of a domestic transaction. And 10(1)(a), I believe, is the most crucial one, as I believe 80 to 90% of the transactions are covered within the purview of the section 10(1) sub clause A. It says that in the case of a supply involving movement of the goods, the place of supply is the location of the goods at the time when the movement of the goods terminates for delivery to the recipient. So as we can see from the definition itself, for a transaction to be considered as an interstate movement, which involves movement of the goods, which is the case in most of the, which is applicable with respect to most of the transactions. So we need to determine if the movement of the goods is taking place, and if so, the place where the movement of the goods terminate for delivery to the recipient, that is the place which will be considered to be the place of supply. So obviously, as we can see, that the place of the supplier or the recipient is of no consequence to determine the place where the movement of the goods terminates. What is important is to understand as to if the movement is taking place and where the termination of the movement is taking place. And it is the place of the termination of the movement of the goods which will determine what is the place of the supply. Now, why it is important? Because it is totally in sync with the underlying principle of the destination-based consumption tax. So it is the destination to which the goods are moving, and it is the place where the goods are consumed. It is the place which is considered to be the place of supply. If we omit the legal jargons and understand in a very plain and simple language, then it is a place where the goods are destined to, and whether they are ultimately getting consumed, that is the place which will be considered to be the place of supply generally. There are exceptions to it, but we will see eventually that it is the place of the consumption of the goods where ultimately the revenue is going to the state which is going to earn the revenue. Now, in this context, let us have a look at section 10(1)(b). Now, this is a transaction which is a kind of which deals with bill to shift to kind of a transaction, whereby you see one purchases goods from a particular person and asks it to be delivered to somebody. So suppose the billing is done to A, but the delivery is taking to B, and the supplier is C. So to deal with this kind of a scenario, section 10(1)(b) is there, which says that if the delivery is taking place at the instruction of a third person, and who is not the ultimately, who has not given the instruction, who is not the purchaser of the goods, then it is the place of business or the principal place of the business of the third person, which will be considered to be the place of supply. Now, to take an illustration, suppose A places a order for purchase of goods. A is based in, say, Bengal. B is based in Gujarat. So A places an order on the B from Bengal to Gujarat. But he asks B to deliver the goods to somebody who is located in C. Now, C may be an ultimate consumer, C may be a further trader. So, as per section 10(1)(b), even though the movement of the goods terminate in the state C, but for the purpose of 10(1)(b), it is the principal place of business of B which will be considered to be the place of business. Now, B will further raise bill to C. So in this case, eventually two transactions takes place simultaneously. A sells goods to B. B is based in Gujarat. So A will raise a IGST invoice on B, considering place of supply to be Gujarat. Now, B will eventually raise an invoice on C also, where the goods are destined or getting consumed. And B will also raise a IGST invoice on C. So B will take input tax credit of the purchases made from A, and ultimately he will sell goods to C. So in this case also, eventually the tax will accrue to the state where C is located, that is Maharashtra. So the principle of destination-based consumer consumption tax is not deviated, but in order to ensure that there is no break in chain of the supply of the transaction, 10(1)(b) has been inserted so that A can raise an invoice on B, treating the principal place of business of B as the place of supply, and raises an invoice on B, who is based in Gujarat, but eventually B will raise an invoice on C, who is based in Maharashtra, and it is the state of Maharashtra which will eventually get the benefit of the GST, since the goods are getting consumed in the state of Maharashtra. Mr. Jindal is asking a question, e-way bill and procedure for illustration. I think it would be useful if you can just elaborate what you wish to ask. Mr. Choksi is asking, in case of tool supply, can we do bill to other state customer and ship to vendor's own place state from where vendor is located and charge IGST to be able to? This question is also not very clear to me. If you can elaborate further, I will be able to answer. Priyanka Jain is asking, amount is mentioned in invoice in bill to ship to concept. Yes, obviously amount is mentioned, otherwise how the GST will be charged. Then Mr. Chike Chandrasekhar is asking, what will be the case of supply of goods to person registered outside the state and purchases made while he visit the place of supplier and supply made with the purchase? This I will answer, sir, in the due course of time. Okay, Mr. Jindal has said that I was just requesting for how e-way bill would be raised in example shared by you. Here the e-way bill, you see, will be raised by A for goods getting delivered to C. So either the e-way bill can be raised by C or A. It does not matter. So now, you see, let us look at the various disputes which arose in the context of the CST Act and how it was dealt by the various courts. I hope the concept which we have discussed till now is very clear, that to determine a transaction, whether IGST has to be levied or CGST or SGST has to be levied, it is important to determine two things: location of the supplier and place of supply. Once we identify that, then for IGST to be levied, it is essential that they are in two different states. If the location of the supplier and the location of and the place of the supply is in the same state, then it will be a case of intra-state transaction wherein CGST and SGST will be levied. Now let us look at some of the scenarios which arose in an analogous provision which existed in the context of Central Sales Tax Act in the erstwhile indirect tax era. In CST Act, Section 3A was almost analogously defined as it is defined in Section 10(1)(a). Here it was stated that the interstate sale takes place if the sale occasions movement of the goods from one state to another. Now it did not refer to the condition relation to where the delivery termination of the delivery takes place, but I believe it does not matter, because what is material is that Section 3 subsection A of the CST Act stated that in order that central sales tax can be levied, it should occasion a movement from one state to another. So there must be a movement of the goods from one state to another for CST to be levied. So there are various types of dispute arose, one of which was, is it necessary that the buyer and seller should be in the different state, or is it okay if they are in the same state? So in this context, there was a judgment of the Honorable Supreme Court, Cement Marketing Company versus State of Maharashtra, Mysore, wherein it was stated that the buyer and the seller being in the same state is not material, as long as the movements takes place from one state to another. In this case, the buyer instructed the seller to dispatch the goods to another state where there was a construction site being run by the buyer. So even though the purchase order was placed by a buyer which was in the same state where the seller was located, but since the buyer had instructed the seller to dispatch the goods to some other state, so it was considered to be a transaction of interstate sale. Another judgment of the Honorable Bombay High Court, order for supply was placed by the administrative office of the buyer in Mumbai to seller in Mumbai, and the goods were dispatched from Maharashtra to Gujarat. It was held that this is an interstate sale. So as we can see that the location of the buyer and seller being in the same state is not material. What is material is that the movement of the goods taking place from one state to another. Now the another question which arises, and which in fact arose in the erstwhile era, is that is it necessary that there should be a condition or there should be a written agreement or the contract for the movement of the goods to another state? Or is it enough if the movement of the goods ultimately takes place? And what will be the scenario in such a case? So herein there are various judgments of the Honorable Supreme Court as well as High Court in the erstwhile era, which stated that it is immaterial whether there is a express or the written contract for the movement of goods is there or not. It is enough if the movement eventually takes place as an incidence to the contract. So if it is incidental or if it appears from the nature of the transaction that the buyer is bound to take the place to the goods outside the state or outside the country, then it will be a case of the interstate sale and it will not be a sale within the state. Now, there are various judgments in this context. Here, there was this various judgment which said that even movement of the goods on the basis of telephonic instruction is enough. The contract for sale need not be in writing, but there should be an obligation to transport the goods outside the state. Now, such an obligation may be expressed or it may be implied, or it can be inferred from the circumstantial evidence also. But eventually, if in totality of the circumstances appeared that it was necessary for the buyer to transport the goods outside the state or to move the goods outside the state, then it will be considered to be an interstate sale. Now, the another question which arises in this context is, whether the property in the goods should also be transferred in the state in which the termination of the movement of the goods takes place, or the property in the goods can be transferred in the state in which the seller is located, but eventually the goods are transferred to a different state and the delivery terminates in the other state, whether it will be considered to be a IGST transaction or not, or interstate transaction or not. What is your opinion, participants? Can anybody answer? Is it necessary? I rephrase my question. Is it necessary that the property in the goods, for example, I give you an example. Suppose it is a X factory transaction. The seller sells the goods X factory in the state of Maharashtra, but eventually it appears from the terms of the contract or the incident of the transaction, or suppose the circumstantial evidence that ultimately the buyer will take the goods outside the state, then does it matter if the property in the goods or if the transaction is a X factory transaction and the property in the goods has transferred in the Yes, somebody has answered that the property in goods should be transferred along with the goods. They are inseparable and cannot be bifurcated. Yes, I'm not saying that the property in the goods has to be transferred or not. Obviously, for a supply to be completed, the property in the transfer of the goods is a must. But my question is that the place of the transfer of property. If the place of the transfer of property is the same as the supplier of the goods, then can in such a scenario IGST be levied? Now here, there have been several judgments of the various high courts and Supreme Court in the erstwhile era of the Central Sales Tax Act. And it says that it is not necessary to determine in which state the property in the goods is transferred. It is enough if ultimately the goods move from one state to another. What is important is the movement of the goods and the sale being intrinsically linked to other. But if the sale is concluded in the state in which is different from the goods to which it is moved, it will be considered to be a interstate transaction. Now, another issue which arises in the mind is what happens if the buyer comes to the place of the supplier and he himself takes the delivery to other state. So here what happens if the buyer himself is taking the delivery from the seller and he is undertaking the transportation of the goods, then whether it can be said to be an interstate sale. Here also, there are several judgments which says that if it is mandatory on part of the buyer to undertake the transportation and take it out of the state, then it will be considered to be an interstate sale. But if suppose the buyer comes within the state and the transaction is concluded, it does not concern the seller whether he is taking it outside the state or not, then it will not be an interstate sale. It will be considered to be an intrastate transaction. So just because the buyer is located outside the state, it cannot be considered to be an interstate sale. But if the terms and conditions are such that it appears that the goods will have to be taken outside the state, or it is mandatory as per the transaction that the goods will be taken outside the state, then it will be considered to be interstate transaction. So what appears from the discussion which has taken place till now is that the location of the buyer and the seller being in the same state is not material. Location of the buyer and the goods where the movement is terminating is what is important to determine whether it is an interstate or intrastate transaction. Secondly, who undertakes the transportation is also not material. What is material is that eventually as a understanding between the buyer and supplier, the goods are ultimately transported outside the state. So that is what is important. Now, here, I wish to share some of the practical experience and something which I believe is important for you to know, to structure your transaction or to know as to how to deal with this scenario when ultimately the books of accounts will be audited or assessed by the authorities. So what documents you should keep in order to establish that your transaction is a transaction of interstate. From my experience of practicing in the erstwhile era of Central Sales Tax Act, I can tell you that usually the assessing officer looks into the documents to verify whether the interstate movement has taken place or not. So suppose you submit the invoice, the place of the supplier is outside the state. The payment is also made outside the state. Everything is in order. But eventually you are not able to produce the consignment note. So many a time it becomes a bone of contention that how do you establish that the transportation has taken place if you are unable to give a evidence or lay down a evidence relating to movement of the goods. So I think it is extremely important that one should keep in its file, along with the invoice, a copy of the consignment note. Even if the consignment or the transportation is being undertaken by the buyer, one must ask a copy of the consignment note from the buyer and attach it with the copy of the invoice to ensure that as and when the assessment takes place, you are able to establish that, look, this is an interstate transaction and therefore IGST should have been levied. Now, why I say that this is going to become a very big issue and one of the most, the area of the biggest litigation in the time to come, apart from the disputes relating to input tax credit, is that it is the state to which the goods are moving and IGST is levied. That is the state which is going to earn the revenue. But it is the seller state where the assessment is going to take place. Because the seller is located in one state, say state A, buyer is located in state B, goods move to state B. So the revenue also goes to state B. State A earns nothing out of this transaction. So it will always be advantageous to the assessing officer of state A to try and see if the transaction can be considered as an intrastate transaction. Only if that is done, then only the assessing officer of the state A benefits. So they always create hurdle, as is my experience in the erstwhile era, to declare a transaction as an intrastate transaction, to levy local VAT or local sales tax instead of CST, because that is where in the earlier era the benefit was also there. In the earlier era, the rate of tax in CST was also very less. If the buyer was in the different state and he was also a registered person, then it was only 2%, whereas the full rate of tax accrued to the selling state if the transaction was treated as an intrastate. But here no revenue will accrue to the local state from where the sale is originated if the transaction is treated as an interstate transaction. So it will always be, you see, advantageous, or it will always be a case of motivation or cause of motivation to the assessing officer of a supplier state to try and treat a transaction as an intrastate transaction. So it is very essential if we keep our documentation in order in support of everything through which one can establish that, look, the movement of the goods has taken place. There was an express agreement. Even you see, there have been various judgment which says that there is no need of a agreement express. It is enough if it is implied. But I believe even in that case, because for example, suppose a buyer comes from the outside states and he undertakes the delivery. Those are the cases where you see the litigation is going to happen maximum. And therein, if there is a agreement which can substantiate that the buyer was under the obligation to take it outside the state, and he was supposed to take the goods outside the state and consume it elsewhere, and it is also supported by the consignment note only then you will have a foolproof case to defend yourself before the assessing officer. Now, let us take some of the question relating to whatever I have discussed this until now. Mr. Advocate Amit Jain is asking, in Gujarat, A in Gujarat is billing to B in Maharashtra and ship to C Gujarat. What to charge, IGST or CGST? Here A is billing to B in Maharashtra and delivering to C in Gujarat. So how the transaction? So here the two invoices will be raised. One invoice A will raise upon B, wherein he will charge IGST. Then B will also raise an invoice on C, who will also charge IGST. B will take the input tax credit and utilize it to pay his IGST liability on his invoice raised to C. Now, Mr. Vijay Kumar is asking, in case of transfer of business as a whole by a dealer to other dealer who is situated in other state, how can he transfer the machines to other state? So here we have discussed this particular issue of the transaction of business in the previous session, wherein we discussed the definition of the supply and we discussed various judgments of the High Court and Supreme Court in the erstwhile era, where it was stated that the transfer of business is not goods, therefore it is not chargeable to sales tax. Now, one may argue that it can be considered as a supply of service because whatever is not goods, it's supply of service. So there also there is a exemption notification which says that if there is a transfer of the going concern, then it is exempt from tax. And transfer of going concern means that the business is or undertaking is sold in such a manner that the buyer is able to continue the business in the same manner as the erstwhile seller was continuing. Now, another question is that in the bill to ship to model, whether the third party, who is the actual supplier of goods to the recipient, has to generate e-way bill. Now, with respect to the e-way bill, I think Rule 138 is very clear that the e-way bill can be generated either by the buyer or the supplier. So who generates the e-way bill is not material. I'll just reading out Rule 138. It says that every person who causes movement of the goods of the consignment shall, before commencement of the consignment, may generate the e-way bill. So anybody who is causing the movement of the goods, they can generate the e-way bill. Okay, I am now taking some of the questions. Somebody is asking Mr. Sanjeev Goski, my question was, vendor in Chennai supplying tool to customer in Bangalore, but the vendor keeping possession of the tool for further supply of parts to customer. Mr. Goski, it is the longest question, so I advise you that I will be sharing my email ID, so you please mail it to me. I will answer you. Mr. Samir Kapadia is asking, under CST Act, where the property ownership was transferred, was irrelevant. Under GST, mere transfer of possession is sufficient to trigger taxable supply. In such circumstances, does it really matter where the property is transferred as long as there is obligatory interstate movement of the good? I totally agree with you. Mr. Kapadia, it is not material where the transfer of the property takes place. It is enough if there is a interstate movement of the goods. Okay, there is Mr. Aditya Singhal who is watching the session in the YouTube. He has asked a question that party A and B registered in Madhya Pradesh. Party A bought goods from party C registered in Rajasthan. Got themselves registered in Rajasthan. Now A has to raise invoice to party B. What to charge? You see, here also there are two transactions. Now, party A and B are registered in Madhya Pradesh. Party A purchases goods from party C registered in Rajasthan and got them delivered in Rajasthan to B. Suppose he gets it directly delivered. So, party C will raise a IGST invoice upon party A because there is an interstate movement by party C to party A. But when the party A raises the invoice upon party B, then it will be a CGST invoice because both of them are based in the same state, and the delivery in the party A, it as per section 10(1)(b), it is the place of the business of party A which will be considered to be the place of supply. So whatever movement is taking place from Rajasthan to Madhya Pradesh, that is already accounted for in the transaction between C and A. And the party B will be supposed to have taken the goods or taken the delivery of the goods from the party A in the Rajasthan itself. That is why, in my opinion, between A and B, it will be an intrastate transaction. Between C and A, it will be an interstate transaction. Okay, now let us move on to the further discussion. Now, there are some of the judgments where you see in one of the very interesting judgment of the Madras High Court, here the newsprint was removed from factory of dealer in Tamil Nadu against order of a Kerala party. But in the meanwhile, the paper was sent to a printer in Savaka in Tamil Nadu itself. And after printing, the printed news magazine was dispatched to Kerala. It was held to be a sale of newsprint by the dealer in Tamil Nadu as an interstate sale, as the sale has occasioned movement of the goods from Tamil Nadu to Kerala. Even though in between, the newsprint was converted into a magazine after printing. But I believe I do not, I have cited or taken out this citation because you see, we usually are in the hangover of the erstwhile jurisprudence, and sometimes it is also necessary to know the jurisprudence to avoid this kind of a disputes. So in my opinion, it is better that if such a transaction takes place, then one charges CGST and IGST instead of CGST and SGST instead of IGST, because such a transaction is going to be a house of litigation, and it is better to avoid it. Then there is a judgment which says that it is immaterial whether the goods are ascertained and not ascertained, as long as the movement of the goods ultimately is supposed to take place outside the state. Then there is also a judgment where it is necessary to dispatch the goods outside the state as per statutory provisions, like say license, quota, or permit issued, etc. Then also the sale is considered to be interstate sale, even though the delivery by the buyer is taken in the state where, say, the state undertaking is supplying the goods. Someone is saying that there is no sound. Is everybody able to hear me, or is there a problem with that particular participant only? Audible. Okay, thank you. Then it appears to be problem at the end of that particular participant. Now, in this context, you see, it would be useful to understand the concept of document by transfer of title of the goods. You see, 10(1)(b) of IGST says that where the goods are delivered by the supplier to be a recipient on the direction of a third person, whether acting as an agent or otherwise, before or during movement of the goods, either by way of transfer of documents to title of the goods or otherwise, it shall be deemed that the said third person has received the goods, and the place of supply of such goods shall be the principal place of business of such person. You see, what happens many a times is that while the goods are in the movement, suppose A purchases goods from B, and the goods are in the course of the movement. In the meanwhile, B gets an order from C, and he feels that it would be futile if the goods are brought to his place of business. Then again he dispatches it to C. So he instructs the supplier or the transporter that you hand over the documents to C along with the goods. This is called transfer of, or the sale of the goods by transfer of document of title to the goods. Now, document of the title to the goods means a document which evidences that the person who is in possession of the goods is represented by the document which establishes his legal possession of the goods. So there are various documents which have been considered to be documents of the title to the goods. Now, one may presume that the documents to title of the goods necessarily means invoice. No. Any document which can establish that the person who is in possession of the goods is legally entitled to be in possession of the goods can be considered to be a person who has the document to title of the goods. Now, various documents have been considered to be document title of the goods. For example, railway receipt has been considered to be document of title to the goods. Delivery order is considered to be a document to title of the goods. Now, here the transfer of the document of the title of the goods necessarily does not mean that there should be an endorsement on such document by the buyer. It may not be possible for the buyer to endorse such a document. It is enough if he gives an instruction that, okay, You hand out the goods to such a person along with, suppose, say, lorry receipt or the whatever documents are there. It will be considered that it is a transfer by sale by transfer of document to the goods. So in one of the judgment, it says that the transfer of document is a symbolic delivery of goods to the purchaser. It carries with itself full ownership of the goods. Delivery of document to title is equivalent to the delivery of goods themselves. In another judgment, it was held that the delivery of railway receipt is enough to constitute delivery of goods represented by the railway receipt. So there are various judgments with respect to the transfer of document by title to the goods. Okay, now let us move to the discussion of the next topic. That is determination of the export or import of the goods. Now the place of supply of the import of the goods or the export of the goods means export of the goods has been defined that it is the place where the goods are actually exported. So if the goods are exported to a location outside India, then it will be considered to be a export of the goods. And export of the goods means taking out of India to a place outside India. So these transactions are considered an interstate supply. And one has a choice either to levy IGST and avail input tax credit or pay no GST at all, claim input tax credit, and take the refund of the unutilized input tax credit. And if the goods are imported into India, then it is treated as a IGST transaction, interstate transaction, and it attracts IGST along with the custom duty. And in some cases of export, compensation says, like suppose import of pan masala etc., compensation says is also levied. Now here, in case of a import or export, some of the judgments which I wish to refer to is that what happens if the goods are sold to a ship which is going to sail, or goods are sold to a air carrier for the purpose of consumption of the passengers. In these scenarios, it has been considered that it cannot be considered to be a sale in the course of export because the goods are sold to the ship or the air carrier while they are located within the boundary of the India. Transaction is completed while the goods are located in India. Place of supply will be considered to be in India. Therefore, it cannot be considered to be an export transaction. In one of the judgment of the Honorable Allahabad High Court, a trader from Nepal came to India. He bought a goods from a establishment in Varanasi and took it out to Nepal as per his convenience. It was held that it is also not a case of export of the goods and it is a sale within the state. So in case of export goods also, you see, it is very essential that you maintain all the documents in support of your claim for export of the goods. That is, you should maintain documents relating to bill of lading and you see other export documents, shipping bill and everything, so that ultimately whether you avail any benefit of or not, or suppose if you avail the benefit of the IG, not paying the IGST or paying the SGST and you wish to claim the refund of the unutilized input tax credit, then you are able to establish your export transaction. Here also you see on flimsy grounds, many a time in respect of export of goods, the refund is being denied that the payment has not been received in foreign exchange. Now, here I wish to point out that with respect to export of the goods, receipt in foreign exchange is not mandatory. As per the Foreign Exchange Act, one can receive the payment within 12 months of the export of 12 months of the date of the shipping bill. So, it is nowhere prescribed in the IGST Act or CGST Act that the payment must be received prior to the refund being granted to you. It is enough if we are able to establish that the goods have crossed the customs frontier of India and the goods have been taken to a place outside India. If that is established, then you should be eligible to claim the benefit of the zero rating as per IGST Act. But you must maintain the documentation, proper documentation to establish that the goods have been exported and taken place outside the India. Now the problem arises many a times is that when the when this current time of where the people are selling goods through websites and many of these aggregators like Amazon and all these who facilitates the sale transaction, and the sale transaction takes place through the courier. In that case, many times they don't maintain the proper documentation through which they can establish that the export of goods has taken place. But I recommend one should have a proper documentation to establish that the export transaction has taken place. Now, another interesting concept, which has been a bone of contention or subject matter of litigation, is a high seas sale. Now, high seas sale was neither defined in the CST Act or erstwhile era VAT Act or anywhere else, nor it is defined in the IGST Act or CGST Act also. So now, what is high seas sale? High seas sale is a transaction wherein, suppose A has imported the goods or purchased the goods from a supplier based out of India, outside India, and while the goods are on the high seas, while that the goods are getting transported to the buyer in India, he sells those goods and he enters into a transaction where the transfer of the goods or the property in the goods is transferred to the somebody else before they enter the customs frontier of India, or where the goods are presented for customs clearance. So in those cases, the formalities for customs, like filing of the bill of entry, etc., is undertaken by somebody else who is not having any contract or agreement with the overseas supplier. He has agreement with somebody who is based in India itself, who has got the goods from the purchased the goods from the overseas supplier, but he sells it to somebody who is based in India while the goods are on high seas. These are the transactions which are considered to be the high sea transaction. So here there is a customs circular post GST dated 1st of August 2017, wherein it has been clarified that the IGST on high sea sale will be payable only by the person who files the documentation for import. So somebody who is getting the goods cleared from the custom authority is the person or the entity who will be liable to pay IGST. Even if suppose there is a multiple transaction on the high seas, all those transactions will not be subjected to IGST. It is only the final transaction. The person who is bringing the goods into the customs frontier of India or is getting the goods cleared from the custom authority who will have to pay the IGST. Rest of the transactions will not be liable to any tax whatsoever because those transactions takes place outside the territorial jurisdiction of India. So as because there is no transaction which has taken place within the territorial jurisdiction of India, there will be no IGST. Similar will be the case where suppose somebody who is sitting in India, he purchases goods say from Singapore and supplies to America. This transaction will also not attract any GST, whether IGST or whether CGST or ICST. Now here one more important clarification is that the ultimate buyer who buys the goods and gets it cleared in India, he will have to pay tax on the final value and not the value at which the original buyer in India purchased the goods from the original supplier. It is the cost to the final buyer at which the customs duty and IGST will have to be paid. Now let us have a look at place of supply, where both the supplier of the service and the recipient of service are based in India. So which can be called to be a domestic transaction in services. So how the place of services in such domestic transaction where both the supplier and the buyer are based in India. Here the default rule, which is in section 12, subsection 2, it says that where the supply of service is made to a registered person, then the place of location of the recipient of service will be the place of supply. And if where the supply of service is made to an unregistered person, then if the address is available on record, then the place where such address is available in record will be the place of supply. But if the address also is not available on record, then it is the location of supplier which we will consider to be the place of supply. So this is the default provision, that it is the place of the recipient of service which is considered to be the place of supply. Now again, this provision is totally in sync with the destination-based consumption tax principle of the GST. So usually if the seller is in a position to establish the location of the supplier, whether if he is registered, then obviously it is very easy to find out the place of the registration. But if the person is not registered, even then this benefit is given for the benefit of the state, for the benefit of the revenue of the state, that wherever the recipient is located, if his address is available, then it is such place which will be the place of supply, and it is the destination state which will get the benefit of the tax. Now, in this context, I would say that it would be very important for a supplier to have some KYC document of the buyer or the recipient if he treats it as a IGST transaction. Because in a later time, even if suppose he raises an invoice on a outside supplier, outside state supplier, but at the time of the assessment, he is unable to provide any documentary evidence as to how he is treating at a IGST supply, then it may be a bone of contention between the department and the SSE, because as I have said, that the assessing officer who is going to assess will be based in the state of the supplier, and it is the burden of proof is on him to establish that the transaction is a IGST supplier, since he is claiming it. And it is very easy for a assessing officer to classify IGST transaction as intrastate transaction and say that now you pay CGST and IGST. Now, there are some special services, specific services, whereby this default route does not apply. For example, in case of a immovable property, it is the place of the immovable property, which is the place of supply. In case of a restaurant or catering services, etc., or the healthcare services, beauty services, it is the place of the performance which is actually important. So place of performance also, in a way, determines the place of the consumption. So wherever the services are performed, it is obvious that that is the place where the service is getting consumed, and that is the place which gets the benefit of the revenue. Now, in case of a place of business of a training or performance appraisal, etc., the transactions are bifurcated into two categories. There again, the destination-based consumption tax principle is kept in mind. If one is a registered person, then it is the place of the principal place of business of the location of such recipient. But if the person is not registered, then the place where the service is actually performed. In B2B transaction, it is the place of the registered place of the business is considered to be the place of the consumption, because you see, it also goes in sync with the benefit of the input tax credit. So if a registered person is based outside the state, and if the IGST is levied, then he will be in a position to claim the benefit of the input tax credit. Now, place of supply with respect to admission to a event or the amusement park, etc., is the place where the event is actually held. But if one is an organizer of some cultural event or educational or entertainment event or sporting event or a conference or fair or exhibition, etc., then again, keeping in mind the benefit of the input tax credit, if one is a registered person, it is the place of business of the location of the recipient. So even if suppose the event is taking place in state B, but the registered person is in state A, it will be considered to be IGST transaction. I think this particular provision little bit deviates from the principle of destination-based consumption tax, because if suppose the event is taking place in state B, ideally it is the state B which should earn the revenue. But here, keeping in mind the benefit of the input tax credit, it is considered as a IGST transaction, and the organizer of such an event, if one is a registered person, then that place is considered to be the place of supply, and IGST will be charged. Then in the case of transportation of goods also, the same principle is applied. It is the location of the registered person. Then banking financial services also, it is the location of the recipient of service on records. Now let us have a look at the cross-border services. Now here also the default principle is that it is the location of the recipient of the service which will be the place of service. Now in the case of the export of service, there are 5 conditions which are essential to be established. That is, the supplier of the service is located in India, the recipient of the service is located outside India, the place of supply of the service is outside India, and payment of such service is received in convertible foreign exchange or in Indian rupee wherever it is permitted by RBI. And the last condition is that the supplier of the service and recipient of service are not merely establishment of a distinct person in accordance with section 8. So again, it is very important that the place of supply and the location of supplier both is outside India for a transaction to be considered as a transaction of export of service. Now here also I will caution and say that it is very much essential to maintain some documentation to establish the location of the recipient of service. So one must maintain a document of the domicile of the recipient if one is an individual, then have some document of the domicile certificate of such a person or the tax residency status of such a recipient. Or if it is a company, then have a documents of incorporation or tax domicile or other documents through which one is able to establish that the recipient of service is located outside India. Now, in the case of a cross-border service transaction also, there are some specified services where this default principle is not applicable. For example, if the services are provided with respect to a transaction where some goods is to be made available for the performance of the services, then it is the location where the services are actually performed which will be the place of supply. But if the service is performed by the electronic means, then the place of supply will be the location where the goods are actually situated. Similarly, in case of an individual service, where the physical presence of the receiver is mandatory, it is the place where actually is performed will be the place of service. Now, these two provisions ensures that if the place of the performance is in India, then the place of supply becomes India, and you see they are not treated as export of service. They will be treated as a intra-state transaction where the services are actually performed, because obviously normally the place location of supplier will be the same state. So intra-state transaction will be treated as an intra-state transaction, and CGST plus SGST will be levied. Similarly, in case of immovable property also, it is the place where the immovability situated is the place of service. So there also CGST and SGST will be levied. Now, in the case of a cross-border service, I believe the biggest area of dispute is going to be intermediary service, or whether a service is a information technology service. Because in case of an intermediary service, it is the location of the supplier which is considered to be the place of supply. So in case of an intermediary, even if one is receiving money in foreign exchange, the recipient is located outside India. If one is facilitating some transaction, one is a broker or an agent who facilitates or arranges for the purchase or sale of the goods or services between two or more persons, then such a person will be considered to be an intermediary. And in this kind of a transaction, it is the location of the supplier which will be considered to be the place of supply. Therefore, it cannot be considered to be an export of service. And invariably, CGST plus SGST will be liable to be paid. Now, this has been a very issue wherein you see in two of the high courts, this particular provision has also been challenged, which is section 13 to 13(8)(b). It was challenged before Honorable Gujarat High Court in the case of Material Recycling Association of India versus Union of India. It was argued by the SAC that it goes against the constitutional principle of Article 286, which says that no law of a state can impose tax when the supply takes place outside the state or in the course of the import or export of the goods or services out of the territory of India. So it was argued that since it is a transaction of export or import, so it violates Article 286. Further, it was said that since the service recipient is located outside India, so the service is rendered outside India, and therefore, on the principle of extraterritoriality, that is, the government of India do not have any power whatsoever to levy tax on a transaction which does not take place within the territorial waters of India. Further, it was argued that it also violates Article 14 because the similarly situated person, for example, one is providing a management consultancy service, then one will not be liable to pay any tax. But if one is performing intermediary service, then one is liable to pay tax. Honorable Supreme Court, Honorable Gujarat High Court considered all the contentions and rejected the arguments of the petitioner. Now, here in this context, it would be useful to refer to one of the judgment of the Honorable Supreme Court, which examined the limitation of the Parliament in enacting legislation with respect to extraterritorial aspect. It was said by the Honorable Supreme Court that Parliament may exercise its legislative power with respect to extraterritorial aspect, provided it affects the territory of India in any manner, directly or indirectly, and it has some impact or effect or consequence on the territory of India or any part of India, or the interest of welfare of the well-being or security of the inhabitants of India. So it is not that the Parliament do not have the legislative power with respect to extraterritorial transactions. It can certainly levy to tax any transaction beyond the territory of India, provided it has some nexus to India and it has some connection to India or inhabitants of India. If that is satisfied, then such a transaction can be levied to tax in India. Similar challenge was also made before the Honorable Bombay High Court. But the Bombay High Court, the matter was before two-member division bench, and the board differed. One member said that, or one of the judges said that it is ultra vires or the unconstitutional, but another member or the other judge said that it is constitutional. So ultimately, the matter was referred to a larger bench, so which is not yet heard and is still pending before Honorable Bombay High Court. Now, with respect to the issue of how to determine whether a transaction is a transaction of intermediary, a circular was issued by the CBIC in 2021, wherein it was clarified that in order for a transaction to be a transaction of intermediary, it is mandatory that there should be minimum of 3 parties. 2 of them are engaged in the transaction of supply of goods or services, which is the main supply. And the 3rd party is arranging or facilitating the transaction of the main supply. So suppose A and B purchases or sells some goods or services between themselves, but such a transaction between A and B is facilitated by C, then it is the transaction of the C which is a service of the intermediary, and it cannot be considered to be a export of service, because the place of supply will be considered to be the location of such an intermediary, and it will be within India. Further, it said that there will be 2 distinct supply in such a transaction. One will be the main supply between the 2 principal, and other will be a transaction between the intermediary and the principal, who arranges or facilitates the supply between these 2 principal. And obviously, the intermediary has the character of an agent or a broker or any other similar person, because he is the facilitator. But it does not include a person who does the supply on his own account. That is, somebody who does the transaction on a principal to principal basis. Such a person cannot be considered to be within the scope of the intermediary. It was further said that just because one is undertaking the transaction of a subcontract, that is, one is actually rendering service on behalf of somebody else, such a subcontractor cannot be said to be an intermediary, because he himself is rendering the service on behalf of somebody else. For example, job work. Now, here it will also be important to discuss the clarification which was issued in the context of the information technology enabled service. Because this is also, you see, I have experienced myself some of the litigation whereby a information technology service, for example, somebody is doing call center service or outsourcing, business process outsourcing service. Department, more often than not, considers them to be an intermediary and seeks to levy GST on the services provided by such information technology enabled service providers. For example, BPO service provider or call center service provider. So here also, in order to avoid the litigation or the dispute, the department or the CBIC has already issued a circular which says that even though the IT enabled service is not defined in GST, but it is defined in Rule 10TA of the income tax rule, and therefore it will be considered to be a place of service outside India if these are the nature of service. For example, call center service, back office operation, data processing, insurance claim processing, legal databases, creation and maintenance of medical transcription, translation services, payroll, remote maintenance, revenue accounting, support services, website services, data search integration services, remote education, etc., etc. Now here 3 illustrations were also given, and it said that If one is himself undertaking this supply to a customer outside India, then obviously he's not intermediary, and because he himself is undertaking the transaction. But suppose somebody provides the intermediary service, that is, he arranges the pre-delivery or post-delivery back-end services, for example, order placement and delivery, transportation of the goods and all that, whereby he arranges these services. He himself is not the transporter or the person who provides these services, but he does the incidental services, then they will be considered to be intermediary services and not information technology enabled services. Now, the last concept which I would like to discuss is the time of supply. Now, in order to know at what time exactly when the tax liability is to be discharged, it is essential to know the time of supply. The exact date when the taxable event took place, because it is necessary for tax to be paid, we need to know when the taxable event has taken place. And the time of supply tells us when the taxable event takes place. So in the GST, section 12, 13 and 14 deal with provisions relating to time of supply. Now, before that, we must know that what is the provision relating to date of issue of invoice, because the time of supply is either the receipt of the payment or the raising of the invoice, whichever is earlier. So it is essential for us to know what is the due date of raising of the invoice. The due date of raising of the invoice is provided in section 31. It says that where the transaction involves movement of the goods, the invoice should be raised before the removal of the goods from a place of the supplier. And where it does not involve movement of the goods, it is the delivery of the goods or the making available to the recipient, the invoice should be raised. And in the case of services, the invoice should be raised not later than 30 days from the date of provision of the service. So in case of the supply of the goods, it is the date of the issue of the invoice or the receipt of the payment, whichever is earlier, will be the time of supply. And in case of the supply of services, it is the date of the issue of the invoice or the date of receipt of the payment, whichever is earlier. And if the invoice is not received within 30 days from the provision of the service, then it is the date of the provision of the service which will be deemed to be the date of the time of the supply of service. Now, time of supply in relation to late fee or interest or penalty etc. will be the date and on which the actual payment is received. So while the law prescribes the date with respect to late fee or late payment or penalty etc., but the law does not prescribe the date of the time of supply with respect to the supplementary invoice. So I think this raising of the supplementary invoice, for example, due to rate differential and all, the supplementary invoice is raised at a later point of time. So the question may arise as to what is the time of supply, because if the time of supply is linked to the taxable event, then the interest will have to be paid from the date of the from the actual date of the transaction. So this is the issue which is still open to debate. Now, time of supply will also be essential to be determined if there is a change in rate of tax. So in case of a change in rate of a tax, the law has tried to sync the time of supply with the taxable event. So if the taxable event has taken place before the rate of change in tax, that is, if the goods have been supplied prior to the change in rate of tax, then the law says that if the rate of tax change in rate of tax has taken place, but where the invoice is issued and the payment is also received prior to rate in change of tax, then the time of supply shall be issue of invoice or date of receipt of payment, whichever is earlier. The reason is that the taxable event has already taken place prior to the rate of change of tax. The invoice has also been raised prior to the change of rate of tax. The payment has also been received. So whichever is earlier will be the event when the rate of tax will apply. But where the invoice is issued prior to the rate of change of tax, but the payment is received after the change in rate, in such a scenario, the time of supply will be the date of issue of the invoice. The reason is that the invoice has already been issued prior to at the time of the taxable event. So that rate will apply. But if the payment is received prior to the rate of tax, then the date of raising of the invoice will be ignored. And the time of supply will be the date of receipt of payment. So eventually, if the invoice or the payment is received prior to the rate of change in change in rate of tax, and the taxable event has already occurred, then whichever ever it is earlier will be the time of supply. But if the goods or the services are supplied after change in rate of tax, then in such a scenario, it will be synced again with the taxable event. For example, where the payment is received after change in rate of tax, but the invoice has already been raised, then the time of supply will be the date of receipt of payment. Or where the invoice is issued and the payment is also received before the change of rate in tax, the time of supply will be the date of payment of receipt or date of issue of invoice, whichever is earlier. So if both has been done prior to the change of rate of tax, only then it is dealing from the taxable event. But if either the invoice is issued after the change in rate of tax or the payment is received after change in rate of tax, then whichever is later will prevail and it will be synced with the taxable event of supply. So friends, with this I conclude my today's discussion. Now let us have a look at some of the questions. One of the question is of Mr. Vijay Kumar. He says that the hotel agent located in Delhi, 5-star hotel located in UP, customer located in Maharashtra, 5-star hotel raises bill on hotel agent at the rate of 28% and hotel agent raises bill on customer. What rate hotel agent should charge on customer? Whether hotel agent will be entitled to ITC of bill raised by 5-star hotel, whether customer would be entitled to ITC of bill raised by hotel agent. Here, sir, the hotel, in case of hotel, it is relating to immovable property. So it will be the place of the hotel. And therefore, the hotel agent, the hotel agent is located outside the state where the hotel is located, then in my view, there is no benefit of SGST which can be taken, but the benefit of CGST can be taken even though it will be denied by the department. But in my view, there is no bar to take the credit because CGST is a central levy, and irrespective of the state where it is levied, the benefit of IT should be availed. But SGST is a state-based tax, and therefore the benefit of ITC cannot be availed. Now, with respect to the invoice raised by the hotel agent being based in UP, he will be raising a IGST invoice on the Delhi customer, and the benefit of such IGST can definitely be availed by the customer based in Delhi. Now, the another question is, in the case of air ocean freight services, service provided and service receiver both are in India, but the outbound ocean freight is going outside the India. Here, due to the place of supply, the place is destination. You see, with respect to freight outside India, let us have a look at section 13. Section 13 says that the place of supply of services of transportation of goods other than by mail or courier shall be the place of destination of such goods. So by all means of transport except mail or courier, it is the place of the destination of the goods which is material to determine the place of supply, and it will be the outside India. Therefore, if the place of supply is outside India, it will be considered to be a zero rated supply. Mr. Sanjeev Goski is asking question whether if the goods are sold outside India, but possession is with vendor only for further supply of. Mr. Goski, you have asked several questions, 4-5 questions. So I advise you to mail it to me. I will try to answer you. I will share my email ID. Okay, Mr. Yasani Bandaru is asking, if we raise a supplementary invoice, then we need to pay interest from original invoice to the date of supplementary invoice. In my opinion, yes, as far as I remember, I am not able to, I will locate that judgment also. But there was a judgment in the erstwhile era wherein it was held that the date of the original supply will be considered to be the date of supply, and interest will have to be paid. Okay, with this, I conclude my today's session. If you have any answer, I am sharing my email ID again. Please mail your queries to me. Thank you very much.
Hello, sir.
Yes.
Thank you so much, sir, for the wonderful session.
Thank you very much. Shall we
It's our
conclude?
pleasure, sir. Sir, is there any date on your mind that we can then announce it here?
Uh, we should do on 4th of February, fortnight from today. I think we should continue to do it on Saturday now that we have, since now we have switched to Saturday. Let us continue to do it on a Saturday.
Okay, sir.
So 4th of February is the next date, and the session will be on the topic input tax credit.
Okay, sir. We can fix it in 4th of February.
Yes, yes. Thank you.
Shall we wind up, sir?
Yes, yes. Thank you.
Thank you all.